If I was to grossly simplify the fundamental revelation of Beyond the J-curve, would it be that venture capital isn't as risky as a fund at a fund level as people previously thought?
Yes, that was one thing. Certainly there are certain nuts and bolts, like doing proper due diligence, alignment of interests, investor protection clauses, which are part of the puzzle, and at that time many institutional investors were not that aware of. By now this has entirely changed. You have far more people in the industry who know what needs to be done, who have really experienced. At that point in time there was a kind of scarcity. But the question about how to manage risk returns, that venture capital investment on a portfolio level are not as risky as widely perceived. That understanding was not there, and to a large degree it is also not there today. They always fear that once the subject of risk is touched, then it has very negative consequences for the industry. So the interest in looking at this, I think, from the point of the private equity industry is not always very strong. Regulators understand that these are illiquid asset classes, but they tend to view liquidity or illiquidity in the framework of market risk. They see you can tackle your liquidity issues by selling an asset on the markets. Therefore, market risk figures very highly in this framework. But it's a little bit like these Inspector Clouseau movies. You know, Inspector Clouseau has his sidekick Cato, and Cato has a standing instruction to attack Inspector Clouseau at any point in time, which typically happens when he's under attack from some terrorists or criminals anyway. So for an illiquid asset class, this framework does not make a lot of sense. Risk management in this area has most to add by protecting investors from selling off their assets, and only sell them when there's really a profitable exit.
But everyone looks through the other end of the telescope, don't they?
Yeah,
it's like you have to pay to be able to exercise your basest instincts and sell in a falling market.
Yeah, well, I mean, probably that is one of the greatest misunderstanding of this asset class, and that was essentially the insight gained through the work on Beyond the J-curve, that venture capital investments on a diversified level are not as risky as perceived, provided that you are allowed to keep them over their full lifetime and only sell them off if the market is buoyant enough.
The thing that scares people about this is obviously the denominator effect, and they have these institutional rules where everything else falls, suddenly they're overweight.
Yeah, essentially regulation paradoxically does not help. In 2010, when you were still around, we had this private equity risk measurement working group where we got institutional representatives from institutional investors who understood that the risk in institutional investors are exposed to is related to the uncertainty regarding the timing and the amount of the cash flow, and not to the final outcome, because the final outcome is usually relatively safe. And we also had an academic advisory board in this, but very quickly you could see the views quite deviating. For instance, neither regulators nor academics see any issue with the undrawn commitments of a fund. Which is clear, because academia is interested in how does the asset class perform. Do fund managers add value? How are private assets comparing against public assets? Whereas a limited partner, an institutional investors, should be interested in how their overall portfolio is doing. And that is exactly the point. A diversified diversified venture capital portfolio is far less risky than a concentrated private buyout portfolio, say. And also how the undrawn commitments figure in. Are there any opportunity costs associated with it? This matters. The academic view is these are two different assets. The undrawn commitments are allocated to Treasury and are risk-weighted accordingly, and this is a zero NPV project, so there aren't any opportunity costs. Experience tells quite differently. When investors ran into problems, they ran into problems because they ran out of funding to support their fund investments. And they ran in problems when, due to the denominator effect, they wanted to sell the assets in a down market. This is exactly what risk management aims to avoid, that you do something like this. Also, you can say that the market is pricing the undrawn commitments in various forms. For instance, if you have secondary transactions, one can see that the size of the undrawn commitments have a significant impact on the discount on the net asset value. It's not just the net asset value of the portfolio that is being transferred. There are also undrawn commitments, and they are essentially priced in.